Hello everyone. In this video, we will be discussing how to calculate bonds rates of return. So from week 2, we know that rates of return is calculated as the profit from an investment divided by our initial investment. In this case, that means as we calculate the rates of return from a bond, we will follow the same concept. Okay. So for example, your rate of return is total income divided by investment. So as long as a bond is concerned, our income comes from coupon and also income comes from the changes in the prices of a bond. So as we sum up these two and divide it by investment in bond, we get the rates of return. Okay, look at this example. A bond increases in price from 963.8 to 1,380.5 and pays a coupon of 21.875 during the same period. So what is the rate of return? Okay. Now look, as we invest in this bond, we earn an interest of 21.875. So that's our interest income. And we also earn an income from the change in price. Our initial price was 963 and now it's 1,380. So difference is the change in price. The idea is, as you invested 963.8 in this bond and current price is 1,380, if we sell this bond, the difference will be your profit from the price change. So this is your interest income and this is your income from price change. As you sum this up and divide by your investment, you get 0.455. So it's basically 45.5%, which is the rate of return from bond. And investment criteria is once again the same, is if this rate of return is greater than the cost of fund that you have invested in this bond, then this is a worthy investment. This is a valuable investment. The next point we discuss is the duration. Changes in interest rate, as we have seen from the past video, have a greater impact on the prices of long-term bonds than on those of short-term bonds. But sometimes it's confusing that what do you mean by long-term bond and short-term bond. A coupon bond that matures in 30 years make payments in each of year 1 from year 3. So it's misleading to describe the bond as a 30-year bond because it's not necessary that cash comes after 30 years. Cash comes each year from year 1 to year 30. So the average time to each cash payment is less than 30 years, you understand. And that's the reason investors and finance managers sometimes calculate a bond's average maturity, which is called duration. They actually keep track of duration because it measures the exposure of the bond's price to fluctuation of interest rates. Duration is also often called Maclaurin's duration after the name of its inventor. So you can see that this duration is the weighted average of times when the bond's cash payments are received. Okay, so what we do actually is, this is the cash payment 1, cash payment 2, cash payment 3, up to cash payment T. So we find out the present value of each of these cash payment and we divide by the total present value, total present value of the cash flows. So look at this example. We have the cash payment from a bond of 90, that's a coupon payment every year from year 1 to year 7, and year 7 it's 90 plus the principal value, which is 1,000. So if we find out the present value individually for each of these cash flow, you can see these are the present values. And as we sum them up, the total present value is 1,300. So that's the value of the bond as we previously calculated. Now, according to this formula, you can remember this present value of the cash flow divided by the total present value. So what we are doing here, this is the present value of each of this cash flow and we divide it by the total present value. Am I right? Total present value. Okay. And then this is the fraction of the total value. So present value divided by total present value. So fraction, and we multiply them by the corresponding year. So this is multiplied by year 1, this multiplied by year 2, this multiplied by year 3, okay? This multiplied by year 3, this multiplied by year 4, this multiplied by year 5, like this. Okay, so year multiplied by the fraction of total present value. Is that all right? And as we sum them up according to the formula, you can remember, we sum them up. As we sum them up, we get our, as we sum them up, we get our duration, which is 5.69. So the duration of this bond is 5.69. We have a very similar example here. These are the cash flows, year 1, year 2, year 3. These are the present value, and this is total present value. As each cash flows are divided by the total present value, then we multiply it by corresponding years, and as we sum them up, we get duration. Now, you may wonder a little, so what's the use of this duration? Well, we mentioned that investors and finance managers track duration because it measures how bond prices change when interest rate changes. For this purpose, it's best to use modified duration or volatility, which is just the duration divided by 1 plus the yield to maturity. Okay, so as we go for modified duration, let's say it's modified duration, it should be duration divided by 1 plus yield to maturity. Okay, so the modified duration measures the percentage changes in bond for a 1 percentage point change in yield. Is that all right? For example, as we have a modified duration, let's say we have a duration of, let's say, 3.6, and we have a yield of 3%. Okay, so 1.03. So if this is our duration 3.6 and 1.03, so what we will get is 3.49. Okay, 3.49%. So what does this measure? This 3.49%, it indicates that 1% change in yield to maturity. Okay, this 1% change to this yield to maturity will bring a 3.49% change in bond prices. So for these two, you also can calculate. This is your duration, 5.69. So if you divide 5.69 by the yield to maturity, which is 4%, you will get a modified duration, which will indicate that for 1% change in yield to maturity, how much the bond price will change. In the same way, here you have a duration of 2.753, as if you divide it by 1 plus the yield to maturity, which is 5%, you get modified duration, which will then reflect that 1% change in yield to maturity, how much the bond price will change.